Camera, action. Welcome to Idea to IPO. Hello, I'm Jennifer Stowell. Idea to IPO has been holding tech startup events for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 150,000 members among all of our meetup groups all across the world. We have organized, promoted, and produced over 2,671 events. By any standard, by any measure, we are the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at ideatoipo.com. Our featured speaker this evening is Roger Royse, one of the top venture capital attorneys in Silicon Valley, and he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Roger Royse. Roger, take it away.
Okay, thank you very much, Jennifer. That is certainly an enthusiastic introduction. You're obviously very happy to be here, and that's great, as should everybody be. My name is Roger Royse. I'm a partner with the law firm of Haynes & Boone, resident in the Palo Alto office in Silicon Valley, heart of Silicon Valley. This presentation is how to form an angel or venture fund, legal, business, and tax strategies. So you are in the right place if you want to find out about angel funds and venture funds. And we're going to, in Idea to IPO style, I'm going to present with slides for an hour from 7 till 8 Pacific. At the top of the hour, I'm going to take questions. So if you have questions, type them into the Q&A box and I'll get to them at the end of the presentation. You can use the chat box to talk to each other if you'd like. I've enabled it where you can talk to all panelists, which is me, or talk to any attendees. Think of it as if we were in a live event, that you were walking around networking, you're going to network through the chat box today. All right. And by the way, feel free to post your information, who you are, what you do, what you like, what you don't like. I'm going to start by giving you my contact information. I just posted it in the chat. That's how you can get a hold of me. Now, at the conclusion of today's webinar, we are going to provide the slides that I'll have, and we're also going to provide a recording, a link to a recording on my YouTube channel. I hope you'll subscribe to my YouTube channel because we've got tons and tons of content and we do this a lot. In fact, I'm here every other week, generally speaking, on speaking about various startup related topics. This is the second time we've done venture funds. I've got new content, don't worry. We've got a big audience here for a topic that, you know, it's kind of surprising to me. I didn't think it would be that popular, but go figure. Wow, look at this. I see a lot of my friends here that are attendees that are logging on. Very cool, very cool. Thanks for coming out. All right, before we get rolling here, I would like to find out who is in the audience. Not that it's gonna make a difference as to what I say, but I'm just nosy. So tell me who we got. Startup entrepreneurs, investors, service providers like me, government, press, academics. Are you a student? Are you a professor? I'm going to turn my light off while you do that. Hold on. The glare was starting to get to me. Okay, so about 40% startup entrepreneurs, wow, a lot of investors. A third of you are investors. Okay. Quite a few service providers. That's an interesting mix. It's a little different than what we typically get. I'm going to hold this open a little longer. Usually it's almost all startup entrepreneurs, but I guess it makes sense given the topic. Okay, that's long enough. We got 40% entrepreneurs, a third of you are investors, 12% are service providers, and kind of a mix of a bunch of other things. All right, thank you for that. I'm not done asking questions yet, though. As you know, we do these events solely on Zoom now, or I say Rob does these events. I'm just I'm just a pawn in this chess game. Rob is the master here. Idea to IPO is the promoter and the producer of the event. I'm just a speaker, and Idea to IPO does these all on Zoom now. We used to do these live. And of course, I didn't have to ask this question when we were live because everybody was from Silicon Valley. These days, it's about 30% Silicon Valley, 50% other North America, 14-15% Asia. Geez, I wonder what time it is over there. Must be early morning. We've got some Western Europe, believe it or not, middle of the night, thank you. Latin and South America, South Pacific. We usually get people from Africa. I don't see a big percentage there yet. Okay, so 28% Silicon Valley, 52% other North America, 12% Asia. Got it. Now that tells me something. It means that I can talk a lot about US law and US issues. Now, I'm going to try and keep this high level. I'm going to try to not get like overly super hyper technical, although it's awfully hard because we are talking about a regulated industry. But I'm going to do my best. Before we get going, again, I just want to remind folks, I see that people are using the chat feature. That's great. You'll find my information in the chat. I'll post it again before we're finished if somebody reminds me. And you should go ahead and feel free to give me your information as well. Again, at the conclusion of our program, you will be getting a copy of the slides as well as the video. All righty, so you should be seeing right now my screen, and I'm sure you do. How to form an angel or venture fund, legal, business, and tax strategies. Now, why this topic and why is it so darn popular? We've got a lot of you here today, and it's not just because we're broadcasting around broadcasting. I like that. It's not just that we're zooming around the world. It's also because there's just been a ton of new funds being formed, and I'm seeing it myself. I've been forming partnerships and LLCs and funds, investment funds, for at least 30 years now. And I can tell you that there's just a lot of them right now. And part of the reason is that it's just so easy. You can go online and almost do it yourself. There are services out there that make it seem like you can do this without a lawyer. What I want you to take away from this is kind of a big picture of what the environment looks like. I'm not going to advise anybody to do any of this without a lawyer because this is a regulated industry. I want you to know that. Not only regulated, it's heavily regulated. And we're going to get to this before the end. The SEC, some states, especially the state of California, have been cracking down on non-compliance. And when they crack down like an avenging angel. So it's important for you to do exactly what you're doing here, self-educate, figure this stuff out yourself, understand what questions you should be asking, where those traps are, where those rattlesnakes are. So keep in mind that even though that I'm going to talk about high-level, broad legal issues, this is not legal advice. I am not your lawyer. You'll have to, you'll have to consult a lawyer if you want legal advice. This is just me talking. And this is me. This is my bio. You can take a look at it at your convenience when you get a chance, because you have all of my information. Now, this is really interesting. 2020, if you were in our last presentation, was a record year for venture capital. $130 billion was invested in this country. Record year. It's huge. 2021 doesn't look like it's slowing down. This is from the PwC Money Tree. I picked this up just today. Venture-backed startups raised $62 billion in Q1 alone. Another new record. Every quarter we have a record and then we hit another record. It seems never to end. The point is, there is a tremendous amount of money in the system right now, venture money in the system. Some people might expect that it's a little frothy, and you ought to know that before you get into this business. There are a lot of funds being formed and a lot of money being spent. Now, I still think there's demand for that money. I do mostly startups, and I can tell you that there are more sellers than buyers, especially in this valley. There are more companies looking for money than getting money. So I still think there's opportunity there, but be aware, it's a big year. There's 2020 funding, like I said, record 130 billion. Incredible. It's just incredible, despite the pandemic, maybe because of the pandemic, I don't know. Q1 funding, we just talked about. Funding by month, a little bit of a dip in February. This came from Crunchbase. I don't have the March numbers. God, I should have March, April by now. I'll get them up next time. But you can see that it's still strong, even though we had a little bit of a dip towards the beginning of the year. And because we got some people here from Europe, 2%, I think, strong around the world, strong in Europe as well. I don't have the Asian numbers up. I'll put them up next time. I can tell you, I just know anecdotally that the numbers in Asia are also almost off the charts as well, just because so much business is being done there. Companies are being funded there in particular. So I'm going to talk about, again, at a high level about venture capital, legal business, and strategies. The first thing you ought to know is that running a venture capital fund is a very risky business. You're investing in the riskiest asset class I can think of. I don't know, maybe games are riskier. Maybe motion pictures are riskier. I kind of doubt it. I think startups are. So as you can imagine, the internal rate of return, if you're in the top quartile, if you're getting all the really choice deals and getting in on, if you play golf with the right people and are being brought in on the really hot deals, you're doing pretty well. Otherwise, you're not. And if you're at the top of the pyramid, you're doing really well. And these numbers are almost meaningless, these statistics, because they're so wildly skewed. Now, I might tell you my theory as to why there can be so much money in the system and so many venture funds when the numbers are so messed up, right? If you look at these numbers, it says, geez, how do people make a living at this, right? You're going to find out before we're done. In fact, I'm going to let you tell me, somebody chat me when you figure it out, when you get into my slides. How is it that, it's kind of like lawyers, think about every case, half the lawyers out there have to have lost that case, right? So the top half are all winners. The bottom half, they're all losers in every case. On average, though, they're about 50-50. They invest in companies with high growth potential. No, that's not it. You're going to find out, and you're going to be surprised when I tell you. It's kind of like the last time I was in Las Vegas. I was playing blackjack, and I found out that hardly anybody at the blackjack table knows why the dealer always wins. That's another question. You can figure that one out. I grew up in a state where blackjack's legal, so I know this. I eventually figured it out after they took all my money. But if you can figure that out, you might figure out why VCs will always win. All right, here is a typical venture capital structure. So not to scare you, but I just want to let you know, this is a typical structure. This is the kind of complexity you're going to get into when you get into the venture fund world. And let me just pause on this and walk through this for a minute, because I'd like you to get the structure down before we start getting into any of this other stuff, because it all kind of flows from structure. Now, I am primarily a tax lawyer. I started out that way. I do more than that now, but I oftentimes tell people the more complexity to live with, the better results you get. That's not only true in tax, it's true in a lot of areas. So let's take a look at what we've got here. You see this triangle here in the middle. I don't know if you can see my pointer, which says fund. That is the fund vehicle. That is the venture capital vehicle, the pooled investment fund. We will call that pooled investment fund. That is the vehicle that takes money from limited partnerships, limited partners, that's the LPs, and invest it in portfolio companies, that's the investments. Now, you'll notice that this starts to get complicated right away, because first of all, the US investors that are taxable, meaning not pension funds and not foreigners, they will just invest directly and take a limited partnership interest in the fund. Okay, there's a tax reason that the non-US and tax exempt investors, by that I mean the ERISA plans, the 401ks, not so much IRAs, but other tax exempt investors, they're going to form what we call a blocker or a feeder company. And it says offshore, but it's going to be organized under US law, a US company that will actually make the investment in the fund. And that's a kind of structure we use depending on what the investment is. Now, if our investment is typical venture fund, right? If it's typical venture fund, so it's only investing in stock and securities and maybe convertibles of startup companies, we don't need that blocker company. We oftentimes see it more as a market matter because non-US investors just don't want to have an interest in a US fund because it gets them into the US tax system and they don't want nothing to do with the US tax system. So we'll oftentimes form a blocker even though they don't need it. It's more optics than anything else. If that fund, on the other hand, is investing in real estate or an active business, then we do need it because otherwise the foreign investor's share of taxable income is going to be taxable to the fund at a very high rate of tax. So that's why you'll see this, the right-hand side of the structure. Now, that's the investor side. Okay, now we've got money. It's gone into the fund, the big triangle there, which is a limited partnership or a limited liability company. Taxed as a pass-through. It means it doesn't pay tax on its income. The income, the gains and losses, pass through to its owners and they get taxed on it only one time. Oh, Sergio got the right answer. Yeah, fee management fees, not so much carried interest. That's why the VCs always win. All right, so although nobody gets rich on management fees, they tell me. So anyway, getting back to the structure here, the fund is a pass-through. So we have one level of tax and it's at the investor level. And hopefully that level of tax is going to be at capital gains rates, right? Which are currently 20% federal. There's also 3.8% net investment income tax plus state taxes, but still 20% federal. You've probably been reading in the papers that the new presidential administration would like to get rid of that preferential tax rate on capital gains and move it up to the ordinary rate, which is currently 37% federal max. It's graduated, it's the max rate. And that's been proposed to go back up to 39.6%, where it was before the Tax Cuts and Jobs Act of 2017. So that's in flux, okay? But for now, it's a great deal. And it's such a great deal, the foreign investors don't get taxed at all on their capital gains that pass through to them. But the US investors get taxed at capital gains rate. And if the fund was smart enough to invest in qualified small business stock, the US taxable investors can pay zero federal tax, zero federal tax. Put a pin in that one, qualified small business stock, QSBS. It is a huge, huge gimme. And we'll talk about that later. But those are the tax sensitivities for the investors. Now on the management side, someone's got to manage the fund. That's the general partner. And if we form this as a Delaware limited partnership, the manager will be the general partner. If it's a limited liability company, the manager will be a manager. But they still serve the same role. They manage the fund. Why Delaware, by the way? These things are almost always formed in Delaware, almost always. And we could do a whole program on that. Delaware, the Secretary of State's office is easy to deal with. They have a well-established body of law. The case law really allows you to do almost anything you want by contract in terms of waiving fiduciary duties. And the thing is that a Delaware court, they will apply your agreements exactly as they're written, exactly as they're written. I could tell you stories you might not believe, where you'll say, well, I don't think they meant that. And the Delaware court says, yeah, but that's what it says, and that's how we're going to apply it. So people like Delaware because you get certainty. Okay, Biden is from Delaware, that is correct. So the general partner is going to have some sponsors. That's the individuals that are putting the whole thing together. They're going to own interests in the general partner. But still the general partner is going to be a separate entity, usually a limited liability company. We used to do corporations, not so much anymore. Usually an LLC taxed as a pass-through. That doesn't have to be Delaware. There's not as compelling a reason to be in Delaware for that entity. And that entity is going to recognize the carried interest. What's that? That's the profits that's the gains. That's their share of the gains from the fund. We'll talk about economics in a minute, but just keep in mind that the general partner's share of the gains from the fund is referred to as carried interest, and it's going to inure to the benefit of the general partner under the structure. Now, sometimes the general partner will take management fee as well. That's usually a percentage of committed capital every year, paid on an annual basis. But oftentimes we'll split that management fee out into a separate management company. We don't have to, but we often do it. If you happen to be, if anyone here from New York, if you happen to be in New York City, there's a tax reason for doing that. But otherwise, there's a regulatory reason. And I'll tell you what that is later. It's not essential in any case, but we often do it. Just like I say, you get better results, the more complexity you can live with. Okay, that's the basic structure. Take a screenshot or keep that in your mind, keep that in your head. One variation on that I want to tell you about, because I know someone's going to ask about it, is, gee, what if we have an accelerator that formed a fund? Because a lot of them are doing it. You know what an accelerator is, right? That's a program where you get all sorts of startup services in exchange, usually for equity. Sometimes you have to pay cash, but oftentimes an accelerator is going to be attached to a venture fund because, wow, they see all this great deal flow, and they even know who's more likely to make it or not, because they've been coaching them for 3 to 6 months. So an accelerator will oftentimes have an attached venture fund attached to it. That's one more level of complexity. So you can see here the portfolio company, they get some money from the fund, they give part of that money to the accelerator, they keep the rest of it, they give equity back to the fund. This is one variation, by the way. I've done this a dozen different ways. But for those of you out there who are really thinking of getting into this business, this is not a bad way. This is not a bad model if you've got everything else going for you that we're going to talk about. So let's talk about that. I'm going to talk today, well, I'm halfway through, going to talk today about what is venture capital and what kinds of funds there are, and then maybe drill down a little bit into some of the specifics. So what distinguishes venture? Why do I say angel and venture capital funds? Why do I keep saying that? Because I don't want you to think I'm talking about private equity funds. Sure as heck don't want you to think I'm talking about hedge funds or nothing like a mutual fund, right? A venture capital fund is a very specific thing. And you will oftentimes hear people say it's a fund that follows a venture capital strategy. That means that the fund invests in startups. It doesn't have to be early stage, but we'll invest in startup companies, but also we'll take a role, right? We'll take a role in promoting that startup and bringing it along. They'll take a board seat. VCs often will. If they don't, they'll take an observer seat. And even if they don't do that, they'll have a rights letter that gives a management rights letter that gives the VC an opportunity to help manage the company. That's essential to being a venture capital fund. That's a regulatory issue, right? Because venture capital funds want to fit within a very specific exception. I don't know if we'll get to tonight or not. For regulatory purposes, that requires it to follow a venture capital strategy. And that's basically what that means. Now you're going to see micro VCs that call themselves VCs. You can think of those as really angel funds, just angels with other people's money. Nothing wrong with that. That's how a lot of them get started. Beyond that, a seed stage fund, it's early money, usually the first institutional money in, 3 to 5 million, we'll say. Mid stage, I think of those as Series B and beyond, and then late stage. And then what we've seen a lot of lately, a ton of lately, are special purpose vehicles, SPVs. And those are funds that are put together simply to invest in one opportunity. And a lot of the VCs I work with, that's how they got their start. They found that one opportunity. They gathered all of their friends together. They formed a special purpose vehicle, pooled their money, made that investment, and they hit a blackjack or something. They made a lot of money on it, and that gave them a little bit of track record. Then they did it again and again and again. So if you have questions, go ahead and put them in the Q&A box, and I'll get to them at the top of the hour. All righty, let's see. By the way, special purpose vehicle is not a VC, but it is a fund. It is a pooled investment vehicle. It is subject to all these rules I'm about to talk about. People seem to think that it's not because it's a one-off deal or this or that, or it's special somehow. Just keep in mind, you're playing with other people's money, you do have regulation to think about. So if you're thinking of getting into the space, I mean, I gave you one model, which was the accelerator. Somebody just asked me about venture studios. Maybe we'll get to that in a minute. But typically, I think that you ought to have a really good business strategy that sets you apart, right? It's got to be more than just, give me your money and I'll go figure out how to invest it. There's got to be something more to that. And the best VCs, the best funds, the most successful ones, they've got something else to the story that they're going to explain, usually in a PPM. So one author that I'm going to get to breaks it down into these sort of categories. Thematic investors, they have a thesis of what is next, right? What do they think is the next big thing? Is it going to be autonomous vehicles? Is it blockchain? Is it who knows? You could go on and on and on, but they're betting on a theme. Domain investors will focus on an industry. I do a lot of work with agriculture technology. You'll find a lot of funds that's all they invest in is agriculture technology. You'll find a lot of funds that all they invest in is health technology. There's a reason for that. You want the managers of the fund to have deep domain expertise, to totally understand that industry, right? Just like you want the startup founder to totally understand their industry. Quant investors focus on the data, people investors bet on people, and this is mostly investment thesis. We like to say bet on the jockey, not the horse. And I like to think that the tech investors bet on the horse. And if you were here 2 weeks ago during Funding 101, I talked about some specific examples of VCs in this valley who are very well known, who kind of fit all of these categories but have much different theories as to what their thesis is and what they invest on, whether they bet on the people or whether they bet on the technology, et cetera. But what is special about you is what I'm trying to get to. What are you going to do better than the next guy that's going to make an LP give you their money to go invest? Okay, let's drill down a little bit on that structure. And I'm going to pick up the pace here a little bit now. I know I'm not going to get through the slides and I'm going to go fast. The slides will be available to you after the presentation. The general partner is a pass-through entity. It receives a portion of the gains. We call that carried interest. It also receives management fees, or we carve that out. Now, why do we do that? Why do we have to have a separate entity to serve as the general partner? Right? Why do I need all these entities? It's just you lawyers trying to get rich, charging me $1,000 each entity. Trust me, that's not it. That's not the reason. That's not going to pay for my BMW. The reason we do that is because if we have a separate general partner entity, that entity can divide up its general partner economics without involving all of your LPs. And it can make changes. People can come and go. And that's regularly done. The GP entity is regularly slicing and dicing that carry among different contributors. They have vesting restrictions, just like a startup. They have employees oftentimes or consultants, and you really don't need to involve. You really don't want to, hassle your LPs with all of those decisions and all of that activity. We just remove that and put that in a general partner entity. Why do we need a separate management investment advisor company? The biggest reason why we would do that is because, as I said, this is a regulated industry. This is an investment advisory function, and it is subject to the Investment Advisors Act. Now, it is subject to an exception, so don't freak out, don't have a heart attack. If you're doing a venture fund, it's subject to an exception from Investment Advisor Act registration, but it still requires a filing and reporting, and it is still an investment advisor. And typically, the VCs I work with, they don't form just one fund and get rich and move to Puerto Rico with Jennifer. No, what they do is they form Fund 1, Fund 2, Fund 3, Fund 4. Well, we don't want to have to form a separate investment advisor for each fund. We use one investment advisor, we put that in the management company, and that entity can actually perform that function. Or we could certainly register additional investment advisors. But that's one of the reasons we do that. So there's an efficiency there because we have an investment advisor that can act over and over again, because you don't want the same general partner in all of these funds, Fund 1, Fund 2, Fund 3, Fund 4, because you're going to have different constituents in each general partner. You might not think you will, but I think you will. You probably will, especially given how long the life of a fund is. I hope that makes sense. Okay, the fund itself, a couple of interesting things, and I'm just going to base this on questions I get when I form these funds. People say, well, what should I be? Should I be an LP or should I be a limited liability company, limited partnership or limited liability company? I love LLCs. They're just so easy. I first heard about LLCs, I kid you not, in the late 80s. Wyoming was the first state to enact an LLC statute. And I remember thinking it was a thing of beauty, even then, and it still is. Limited liability, but it's a pass-through for tax purposes, right? I think it's great. There's some little corporate nuances that the statute's fixed as well, but we won't get into that. It's just easier to deal with, right? It's much easier than an LP. And nobody in an LLC has to have unlimited liability. In a limited partnership, there's a general partner that has unlimited liability. Granted, liability is rare in a venture fund because something has to blow up pretty dramatically for the fund to get sued, but it's possible. So why are most funds limited partnerships, even today, even at 30 years after California and Delaware have an LLC statute? And I think it's just legacy. I think it's just legacy reasons. It's just, that's what they always were. They've always been LPs, and it's just hard to change something that just always was, right? So you're going to see a lot of funds as limited partnerships. I'm sort of indifferent. I won't fight somebody if they want to be an LP because it's just terminology, but I'd give the advantage to LLC myself. If the client doesn't care, I'll go LLC. Term of fund, fund terms, if the VCs in the crowd can disagree with me, anecdotally, it seems to me they're getting longer. But typically you have a term. It used to be 7 plus 3 1-year extensions. And I just think it's getting longer. I've been seeing more funds that just say 10 years plus extensions. And there's good reasons for that. It takes a lot longer to go public. If a company goes public at all, most of them won't. So you have to wait till you get acquired. So it just takes a little longer to get to an exit. That's just me. That's just my experience. And anecdotally, that's what I think I find. But typically during that term, there's also going to be an investment period. So you take the money into the fund. And by the way, it doesn't come in all at once. A portion of it will come in on close, and then you'll call the commitment. So your investor commits to the fund, and you call it over a period of years, and then you deploy it as quickly as possible. You don't want excess cash just laying around in your fund, right? And you're given a certain amount of time to deploy that money to invest it. Then the rest of the time, you just sit on that egg and wait for it to hatch. Now, why is it you don't call it all at once, do you suppose? Why is it that you don't say, look, this is a $100 million fund. Everybody has to give me their money. We're going to put $100 million in the bank, and I'm not going to come and bug you anymore until you get distributions from me. If anybody can guess why you wouldn't do that, especially since it's going to take you a few years to spend all that money, chat me. I want to know if anybody, okay, I got one answer. I want to get a couple more answers. Yeah, I think Larry's right, if I understand what you mean. But the reason is that it's going to lower your IRR, right? It's going to lower your rate of return. So, you don't want cash sitting around, getting minimal interest. You wait, you invest it as quickly as possible. All right, management fees, 2 or 2.5%, depending on the size of the fund. Oftentimes, and that's per year, and it's based on committed capital, not contributions. It runs from the date of closing. It stops at some point, when the managers are not really doing anything but kind of waiting, like I say, for those eggs to hatch. So, and it's an annual fee based on committed capital. Now, bear with me for a minute here. Consider this. Let's say we have a $100 million venture fund. And let's say that fund has a 2% per year management fee. Now, let's say that management fee stretches out, I don't know, for 10 years. That's 20%. That's committed capital of $100 million. It's a lot of money. It's a lot of money in management fees. Keep that in mind. That number can add up. So the question comes up, who bears that burden? And it varies. This is one of those things that gets negotiated. We might specially allocate it to the limited partners capital accounts, so they bear it, or it might be an expense of the fund itself where it reduces the amount of carry that the managers and the LPs get. You know, one thing I've seen, because investors have kind of figured this out and said, that is a lot of money. I've seen fee-less funds, no management fee at all. It's all carry. Not very often. I have seen that though, just to let you know. The carried interest, that is the percentage of the gain, right? It's a percentage of the gain that the general partner is going to get. Now, sometimes this is tiered, so it'll change, you know, after a certain rate of return. The funds I do tend to be a little smaller, and we do not do that. We don't go through the brain damage, but bigger funds will do that. And sometimes we have catch-up allocations. I'll show you what I mean in a minute. As I already said, you have to make a decision. Is it applied against the total fund gains or just the gains net of expenses, like the management fee and the fund expenses? There are a couple of different ways of calculating carry, a lot of different ways, but let me give you two that you're going to hear a lot about. The European waterfall, that's where your investors get all their money back from proceeds of sales of stock before there's any carry that gets distributed, before we start splitting up the gain. There's another type of carry that I don't see as much anymore called the American waterfall, the deal by deal. So every time you exit a company, you figure out what your gain is on that particular investment and you split the profits up. If you do have a deal by deal distribution, you have to have a clawback. What's a clawback? A clawback is a clause that says that, look, if you, Mr. General Partner, have taken more profits out of this deal over the life of the fund than the 20% you said you're going to take, then you have to give the excess back. And with an American waterfall, that could happen because you have first investment as a huge winner. So Mr. General Partner takes 20% of that. The next four are all losers. Say they're complete losers. Well, so GP doesn't take any of that, but if you calculate what percent of the entire fund they took, it's going to be a lot more than 20%. So they have to give some of that back, right? That's a clawback. Now, I've been through so many clawbacks. I've been through so many funds. I've seen them burn out. And we oftentimes, this is heavily negotiated, and the investors have gotten smart enough to limited partners to say, look, we don't want a clawback that's backed by a limited liability company that could go away tomorrow. They call it limited liability, right, for a reason. So we want you to guarantee it, Mr. Sponsors. So they're oftentimes asked, and then we have a negotiation. Well, is it joint and several? Does every sponsor guarantee all of it because one guy's got a house and the other doesn't? Or do they guarantee their pro rata share? That's called several liability, etc. We go on. And I've been in litigation on the back end on both sides of that. And I just tell you anecdotally, it's just not often collected. It's just not. I had one fund that aggressively went after a GP sponsor for that. And even that we settled for a small fraction. So what do I mean by catch-up allocations? We're at 7:43. I'm going to pick up the pace here. Sometimes what you'll see is that the limited partners get their capital back first, right? Whatever they invested. Then we don't just do 20/80 going forward. Then we give 100% to the general partner until the general partner has 20% of all distributions, then 20/80. As you can see, that's a lot more favorable than just saying 100% of the LP, then 20/80. I've done it both ways. Oftentimes you'll have a hurdle rate, not in the smaller funds that I do, the bigger ones you do. So you give a priority return to the LPs before you start splitting up that carry. I am not going to go through this in depth because it's late and I'm trying not to give anybody brain damage. But I do want you to know that the accounting here is more tricky, is trickier than you think. And distributions will not necessarily match income. You can force that to happen, but okay, we'll give you an example. Use this example. General partner doesn't put any cash in. Usually they'll put 1% in, but our general partner does not put any cash into the company. LPs put in 100. In year one, they have $25 of income, and they distribute that $25. But the LP, until they get $100, the GP doesn't get anything, right? So the LP, it's $25. All right, wait a minute. This entity has $25 worth of income to allocate. Who are we going to allocate it to, right? If we allocate it to LP, the LP is going to say, well, wait a minute, that's not fair. I didn't get my $100 back yet. You know, I'm still in a loss position. I got to pick up income. If we allocate it to the GP is going to say, well, wait a minute, I didn't even get a distribution, right? So we have this issue. Now, what a lot of fund agreements do, for my CPAs in the audience, and I know you're there, I saw you sign in, you'll see a lot of documents that will just say, let the accountants figure it out. I know you accountants hate that. I've heard that. In other words, they use what they call targeted capital account allocations. That doesn't really answer the question. I tend to want to draft exactly what's going to happen and then model it, or have the accountants model it. And even then, we're going to get disparities. Someone's not going to be happy about it. So I will put a tax distribution clause in the agreement and say, look, whoever gets the income is going to gets allocated the income for tax, is going to get a distribution that covers the tax liability. We have kind of a similar anomaly in management fees. I'm just not going to go through that now. It's too many numbers. Take a look at this at your leisure, but you really have to think through this stuff. You really have to think through this stuff at the front end so you know what you're getting into. And like I say, it's so easy now to go online and just form a fund without really having to think about it, because there are plenty of people that'll let you do that. And it's not a really good strategy. Capital commence, we talked about that. It's drawn down as needed. The GP might be expected to contribute at 1%. Oh, this is good. What happens if you have a default? Remember what I said, you're going to have a commitment, but people are going to contribute capital later on in the year, or in later years as you need it. What if they don't? What if they change their mind? What if they get divorced? What if it's Bill Gates? Okay, Bill Gates could probably still fund his account, but let's suppose it's somebody else who got wiped out in their divorce and now they can't fund their account. Now what are we going to do? You might have to sue that LP. Well, that's a drag. You don't want to sue your investors. You're not going to be doing a fund two once word gets around, theoretically. So usually you'll find extensive default provisions that provide that the general partner can unilaterally do all sorts of draconian things, reduce the amount of their capital, give them a real haircut on what they own, take their voting rights, remove them, all sorts of stuff. So just keep that in mind. Distributions, typically, as soon as your investment is liquid, it gets kicked out. You don't want to be sitting there holding on to that stock. I was involved in one fund where it was two managers, a man and a woman. They had a falling out. They couldn't decide on anything. They couldn't get anything done. Unfortunately, I was an investor. I think they made 10 investments, maybe 20. All of them but one failed. The one that succeeded went public. It went public in a big way. It was a huge win. It would have made up for every other. It would have been a huge win for the fund, but the managers were fighting and they just couldn't get around to distributing it. And by the time they distributed it, that investment had gone way down in value. The investors were not happy. They weren't happy about that. Okay, so that's why I say you distribute as soon as you're liquid. Sometimes the fund allows recycling or reinvesting capital, usually oftentimes only before all the committed capital has been called, but sometimes after. I'm moving fast because I want to get through more in the 10 minutes I've got. Interim financials, just be prepared to give reports and financials. Yes, you should get audited. Now, there are exceptions. There are regulatory exceptions that do not require audits, but I still think you should get audited statements if you're in a fund. And the interim financials will usually, they'll mark to market for financial accounting, not for tax. Website reporting is very popular now. And I got to tell you something, just get the back office support. I really don't try this yourself. Investor relations, everybody does. That's the 8 o'clock train in the background, by the way, going through Palo Alto. Everybody does for a little while until they, screw it all up and then hire a professional to handle that. So that's my pitch for the back office services. There will oftentimes be an investment or an advisory committee. They represent the limited partner's interest. They value the investments. They decide if there's a conflict of interest, stuff like that. There'll be clauses in most agreements for the removal and replacement of your general partner. There's what they call key person events, because remember, even though the general partner is an entity, there's sponsors behind it, and there are key people behind those sponsors, and you want to make sure that your key person sticks around. Co-investments, parallel funds, blockers, SPVs, you start seeing side letters all over the place once you get into a bigger fund, between the time you start and between the time you close. Why is that? Because you've got one document. It's not subject, you negotiate with one anchor tenant maybe, or one cowbell investor, but that's it. You don't renegotiate your document with every investor. You have one document, but people want separate things. They want to pay you a little less carry on their interest, or I don't know, they want a right to co-invest. What does that mean? They can invest in anything the fund can invest in, stuff like that. So you'll see side letters. Smart investors will demand to see everybody else's side letter. The rest of us won't worry too much about it. So the PPM, and if you have questions, pop them into the Q&A box. I see that's already populating. That's the private placement memorandum. The number one question that I get about private placement memoranda is, do I really need one, right? And most of the time is no, legally no, because you're going to rely on a securities exemption that doesn't require it, because you're only selling to accredited investors, maybe even what we call qualified clients, which are even richer than that. So you probably don't need one, but if you don't have one, you still got to make a bunch of disclosures. So we'll pop that into, and you'll provide risk factors, and we'll pop that into a subscription agreement. But the PPM, the private placement memorandum, what that does, it talks about who the team is, what your track record is, what your strategy is. Remember early on in the hour, I said you got to have a story. What is your story? Why are you going to win? What are you going to do that's different? What's your theme, your sector, your domain, et cetera, your industry or your focus? So it's a really good marketing document, and it's something that sophisticated investors expect to see. So I would say you don't need one, but it's a really good idea if you're going out to a broader pool of investors. They're going to want to see it, and it can be a really good marketing document. Don't need one. You can just like a startup company, you can just rely on a pitch deck. Just make sure that you have risk factors and other disclosures in a different document. And yeah, here's everything that you would have. I think we covered everything. Those are all the items you'd want to have in your PPM. It can be a very extensive document, by the way. Okay, now for the fun part of this, securities law issues. We can't, in my 7 minutes left, all I can say is that, look, there are federal securities laws that apply that you must comply with. Most often we do what we call a 506 exemption. That's a private offering. There are state blue sky laws that you must comply with. You got to worry, wherever your investor is, you have to find out if the laws of that state have a particular notice requirement. A lot of them do. You don't want to mess that up. Some are pretty harsh. Washington State, for example, gives people a rescission right if they get this wrong. Last time I checked, Florida had a rescission, a 3-week prior notice requirement. So you have to check every state, and you have to check often. Investment Advisors Act, we talked about that. There are exemptions, but it still requires a filing. Investment Company Act, there are exemptions for venture funds, but we just have to be mindful and we have to meet certain requirements. A couple other things I want to kind of raise here. Broker dealers and finders. No, you cannot use an unregistered finder to go out and get money for your fund and pay them a percentage of what they raise. And don't try to get around it by giving them a piece of the carrot either. If you give someone success-based compensation, the SEC views that as a broker dealer. Now the good news is that we may get an exemption for finders. Last I checked, it was still lingering at the SEC. I don't know if Joe Biden's SEC is going to be kind and gentle enough to give us that, but definitely, we have to pay attention to that issue. ERISA, that's when you have employee benefit plan investors. If you're doing crypto funds, and I've done them, it's a whole nother ball of wax we have to worry about. Lots of stuff, tokenized funds. Steve Wozniak did a tokenized fund a few years ago. You might have read about it in papers, got lots of press. What's that? That's a fund that trades through digital tokens. Here's one that people mess up all the time is if you're relying on this exemption that we always do, Reg D or 506, the private placement exemption when you sell interest in your fund, that means you can't advertise or solicit. That means you can't have a website that says, hey, I've got a fund. See me if you want to buy into my fund. A lot of people make that mistake. And you might think it's a harmless error until you go read what the SEC thinks about it. And if you think the SEC is bad, just wait till you see what California does when they find people violating these highly counterintuitive cookbook and formalistic rules. And then there might be some other regulatory agency. I did a fund one time that was subject to FTC regulation because they did all media companies. So go for FCC rather, because they did all media companies. We talked about tax matters. I want to mention one other thing about tax in my time that I've got left here. And that's Internal Revenue Code 1061. Let me pause on this and let's talk tax. So normally the general partner is entitled to capital gains treatment on their share of the gains from the fund, right? And you hear about this, it's taxation of carried interest. You've heard politicians complaining about this for 10 years, maybe 20. So in 2017, our Congress, signed by the president, enacted a law that says, look, if you're a general partner, so you're not putting cash in, you're just getting your carried interest for services. In order for you to get that capital gains rate, you have to hold that interest for 3 years. Not only do you have to hold your interest in the fund for 3 years, but the security that gets sold must have been held for 3 years. If you don't hold it for 3 years, you don't get long-term capital gain treatment. You pay the higher rate of tax. There are so many ways around this, but that is the law currently, and you should be sensitive to it. Now, the waivers of 1067 gains, be careful about that. The IRS is hostile to that. We recently got some regulations that are relatively pro-taxpayer, and the Biden administration did say they were going to roll those back. We'll see what happens. It sounds like they're going to take a little different position, not only get rid of, the Biden administration would like to get rid of favorable taxation of capital gains and carried interest, favorable taxation of carried interest, as well as get rid of the favorable rate on capital gains above $1 million for taxpayers making above $1 million anyway. So what I'm trying to say, there's a double whammy coming that we might not have this benefit anymore. And my prediction is if that happens, is that fund economics will change, right? And I told that to the press last week and they refused to print it because they don't believe it. But I think that's what's going to happen. I think fund economics will change if the tax system change, right? Because you've got these economic decks that have been, dealt based on a set of assumptions are going to be redealt when the assumptions change. Mark my words, folks, you heard it here first. All right, just a couple things I want to touch on before my 2 minutes is up. Don't forget about anti-money laundering and know your customer. We have to be concerned about this. For sure, you can get in a whole lot of trouble if you're taking money that you shouldn't be taking. You have an obligation. Let me put it that way. If there's something suspicious about what's going on. And then privacy laws. And again, here in California, as you might imagine, has its whole new own set of privacy rules and disclosures that have to be made. I'm not going to talk too much about foreign funds. I'll just say that if you do anything foreign, you have to worry about FATCA. I don't even remember what that stands for anymore, but it is the rule that requires foreign financial institutions to report to the Internal Revenue Service who their investors are and people holding accounts with them. It's a real hassle. It creates real problems. I'll tell you, real problems with our foreign funds. By the way, that's another Biden administration proposal, is to tighten this up and have additional bank reporting for any foreign transactions, because there's still a view that even after FATCA, even though they might have stopped money from sitting in secret Swiss bank accounts. There's still a view that money is moving and not being reported as income. If that happens, it's going to be tough to get foreigners' money. Foreign LPs, we talked about withholding taxes. This is all tax stuff. I want to pause on this. If you are doing a foreign fund, again, it's another ball of wax. Just keep in mind that there are special tax regimes. I'm fighting with the IRS right now over a PIFIC issue, they call this, Asset Foreign Investment Company issue. It is incredibly punitive if you mess this up. It's super easy, to not mess this up. That's all I'm going to say about it now. Just, keep this in mind. There's a whole set of tax rules we have to worry about in the foreign area. And of course, we can't talk about foreign without talking about CFIUS, right? And CFIUS is the Committee on Foreign Investment in the United States. And it now, because of something called FIRMA, applies to funds. And if you have foreign investors, first of all, if you're a foreign fund, you're subject to CFIUS. And if you have foreign investors in your domestic fund, your US fund, you're subject to CFIUS. And what the rules are designed to do as a practical matter is just make sure that foreign individuals or foreign companies don't have controlling stakes in US businesses or access to technical information, influence over decision making, etc. And it used to be just focused on critical technologies. Now it's much broader than that and much more complicated because for a fund, this is all you need to know, but for CFIUS generally, it's focused on anything subject to export control. And finally, the last thing, I'm not going to talk a lot about this given that I'm over time, but several of my funds eventually hear about SBIC, Small Business Investment Companies. This is a venture fund. It's licensed by the SBA. The beauty is it can borrow money at low rates, a lot of money. The SBA will guarantee those funds. So you raise $1, you borrow $2, up to $150 million, and then you just meet the requirements and how you invest it. Honestly, my funds that have investigated this tend not to do it. And the reason they don't do it is just because of all the restrictions that are placed on them. Plus, they got to pay interest to somebody, and that reduces their return. But if you're interested, there is a way you can get the federal government to help you build your fund if you're willing to live with all of these restrictions. There are numerous other kinds of funds. I'm only talking about venture funds. There are community development funds or private equity funds. There are real estate funds. There are tons and tons of different kinds of funds. Today, we're just angel and venture. I hope that this was informational and illuminative, and you've come to realize, is that a word, by the way, or did I just make that up? Anyway, that you've come to realize that this is a difficult area and to be, not to take this lightly. All right, CFIUS sounds like a character from an ancient Greek play. It certainly does. And it is a tragedy, so you got that one right. Okay, so I am going to stop sharing my screen. And now I'm going to go to questions because, holy cow, we got lots of questions. Let me take the easy one first. Will we get a recording? Yes, you certainly will. And that reminds me, let me send you, again, in the chat, information on how to reach me, because if you don't get a recording, by the way, that reminds me, you're also going to get a digital copy of my book, Dead on Arrival, How to Avoid the Legal Mistakes That Could Kill Your Startup. So look for that. But while I'm at it, if you are really serious about this, you should read another book on top of mine, in addition, after mine. After you read my book, I would really recommend The Business of Venture Capital. I can't pronounce the author's name, but it is an awesome book, The Business of Venture Capital, and this will tell you quite a lot, maybe everything you need to know to get into this business. All right, back to the questions. How does a Nevada corporation compare to a Delaware company? Because we're going to open our investment marketing office in Vegas. It depends what that company is going to do. I have actually formed funds back when I was foolish enough to think I could form mutual funds. I did them in Nevada because of their state regulatory environment and tax, by the way, because Nevada used to be, it still is tax-free, but we'll just say the bloom is off the rose on that one. So Delaware is still the preferred jurisdiction for the formation of venture funds and venture fund entities. I understand why people want to go to Nevada. I'm a Nevada lawyer, by the way. I'm licensed in Nevada. You know, it's lawful for me to play blackjack there, not the way I do it though. But I still don't form Nevada companies, hardly ever, unless the company is based there, for a couple reasons. Number one, we've got so much law in Delaware. You have instant credibility if you're Delaware. And number two, surprisingly, Nevada is kind of complicated when you're forming new entities. They have a business license requirement that people regularly get wrong. So I don't want to diss Nevada. I may move there someday, but and I am licensed there, but Delaware is the jurisdiction of choice. Now, if you are actually opening an office there and you're going to have people there and you want to put your management company there, that makes perfect sense. I'm with you all the way. Nevada, yeah, go for it. But if you're sitting here in California and you heard that you could avoid paying tax by forming an entity in Nevada, you have been misinformed. It just doesn't work that way. California is going to tax you based on economic activity, not so much on, you know, which state is on your charter. Somebody chatted, what about a Florida corporation? Same issue, exact same issue. You know, for your management company, if you're sitting in the state, I'm with you 100%, you know, form under that state's law. But otherwise, I think you're better off just being Delaware. Okay, is there any advantage to creating a C Corp versus an LLC? We could be here an hour. So here's the thing about it. No, the answer is no. There, that's done. I guess it did take an hour. Let me tell you why. A C Corp has two levels of tax. You get taxed at the corporate level, and then when those earnings get distributed, you get taxed at the individual level. Just plan on paying 50%, all right? When you add in state tax, it's more than that if you're in California. An LLC, we can elect to be taxed as a partnership. That's one level of tax. It's a lot lower. If it's capital gains, it's way lower. It's 20% plus state plus net investment income tax of 3.8%. So there's a big tax advantage. I know what you're thinking. You're saying, well, wait a minute. C Corps are only taxed at 21%. Individuals can be taxed at 37%. Okay, so two things about that. Yes, that's true, but that rate, you know, is almost certainly going to go away. Joe Manchin might keep it from going to 28%, but I think it's going to hit 25. Secondly, there are state taxes on top of that. And thirdly, you're for this kind of entity, you're still better off with one level of tax than you are with two levels of tax, even at a lower rate. So I don't think there is an advantage. And anyway, that's my view. And most of the time, almost always, we're going to form as an LLC. Would a VC prefer an exit earlier than the fund's duration? For example, well, sure, absolutely. They want an exit as soon as possible. I mean, that helps their ROI if it's a good exit, right? They want the biggest exit they can get. Let's back up a second. Your VC, you know, this might not be obvious, and if it's not, it's because I didn't make it obvious. I'm sorry about that. But they're thinking ahead. They're thinking about their next fund, right? They're thinking about getting a really good return to their investors, so they can go out and they can say, look at the return that I got. Look at the internal rate of return I got on my last fund. Look at, well, they're going to, you know, on absolute terms, look at what I invested in and how great it was. I am so connected. I can find good deals. And secondly, look at the overall return I got. Well, if you can exit earlier, you get a bigger rate of return, provided it's at a big enough number. So they're going to time this however they have to get the highest rate of return. I'll let the math wizards, Gia, I'll let you, explain how you calculate rate of return. But for the rest of us, just understand that, yeah, you want to exit early if you can, if it's a good exit, unless you're going to get a much bigger exit by hanging in there longer. Do non-GPs also get a carry, like principals, investment associates, and venture partners? Aha, good question. That's why we form a management company. The answer is yes, we can do that. We can slice and dice and carve that carried interest up through the management company to reward all of these other contributors in the fund. That's why we do that. That's why we have a management fund reason, and it works really well. It's very slick. So yes, the answer is yes, they can. Now they don't always. I mean, you might decide you want to take cash. I mean, you do take cash. Do you take cash? If you take cash, you might get paid in cash. If you don't, you might get paid in carry. Whether that's a good idea or not depends on the fund. But go see my first slide about fund economics and how well they often do. Where does a holding company fit into this picture of investment from the VC? Would it make sense to take a regular LLC, decide to make that same company a holding company of multiple LLCs? I'm not sure what you mean, so I am going to do what the politicians do and just rephrase that into the question I wish you had asked me. So you're going to form a different fund vehicle for every fund. There's Fund 1, that's going to be the first limited partnership. Fund 2 will be a separate or LLC, a separate entity. Fund 3 is a separate entity. You're probably going to form a different general partner for each one of those funds too, because you've got different principals, investment associates, and venture partners, right? You've got different constituents in your general partner. The management company can stay the same because it went through all the hassle of being an investment advisor. And we want to just maintain that. So, so it can just file the same ADV every year. So, yeah, you're not going to have a holding company in this. What you're generally going to have is a lot of separate companies over and over again. And I think I know where you're going with this question, because I get this complaint a lot. It's like, holy cow, that's a lot of entities. That's $800 a year minimum taxes for each one of them in California. That's a $2,500 a year minimum to file tax returns. I got to pay you, the lawyer, to do this stuff every year. That's a heck of a lot of overhead to have all these entities. And I'm sorry, but I do not have a magic bullet for that. I wish I did. I'd make a fortune. But it just usually takes, it's like I said, the more complexity you can live with, the better the tax result and the regulatory result that you're going to get. Okay, our best customer is back today. His name is Anonymous Attendee. Thank you for being here. He's at every presentation I've ever done, and he's always got awesome questions. And he asks, what range of time would you say is involved putting together these structures and maintaining them? Seems very complex with moving parts on top of our involvement, investing in it. Boy, you're telling me it is. However, the legal side, and in Silicon Valley, any lawyer who does this has this down to a science. And the legal side is relatively easy, right? We're going to get that. I mean, I shouldn't say easy, but the legal side is not your biggest problem. Okay, let me just put it that way. So that's not going to hold you up. We can do documents pretty quickly once you know what the terms are and once you know what the market will accept. And I've got a whole system for just kind of rolling that out and structuring it and scripting it so you don't spin wheels and waste time. The difficult part is going to be all the other stuff that you just mentioned. Dealing with investors, that takes forever. I'm just going to warn you right now, it takes forever. Because people, when you see them out at the Rosewood after they've had 3 martinis, yeah, they love your idea and they're going to throw money at you to invest in your fund. In fact, you should just back your pickup truck up to the Rosewood and let people just load it up with gold bars for your fund. The next morning, they might not love it so much, and you're going to have another conversation. That's going to go on and on and on. It's just going to take longer. That's just been my experience. There's other aspects of this that you need to think about. Here's one that's going to surprise you. Here's a tip for you, banking. Make sure you've got a good banking relationship. Get that in place early on. You don't want that to hold you up when finally somebody says go. So banking, I've had funds that are doing anything just a little bit different. They're dealing in crypto. They're in a foreign jurisdiction. All of a sudden, banking becomes very difficult. Not even crypto. They're tokenizing. Banking becomes a problem. So, so to answer your question, what range of time? honestly, it takes me, in fact, just this year, I did one in a weekend, but that fund still hasn't closed. It'll be 3 months before we close. So the legal work doesn't take that long, but you better plan on months from start to finish to get to your first close. Alrighty, current crowdfunding. Someone wants to know about crowdfunding restrictions. Yeah, you can't crowdfund a fund. Can you? I don't know. I suppose you could. I've never done one. I don't think you can. But let's talk a little bit about securities regulation, though. So the funds will almost always, unless you mean Reg D crowdfunding, if that's what you mean. Yeah, I mean, you can do that. There are platforms that allow you to go on and raise money through 506, and that's what these funds will typically do. That's usually the securities law exemption that they use. I thought if you're talking about Reg CF crowdfunding, that's problematic. But so Reg D is a private placement. It means you're raising money from accredited investors only. You can do that on a platform, a crowdfunding platform that deals in that. And there are platforms that are tailored and will allow even funds to raise money on their platform. Absolutely. There's two kinds. One is where you're raising money from people with who you have a pre-existing personal relationship, or you're using a broker who does. And for those funds, you can just take their word for it. They will self-certify their accredited status. Very easy. It's how we did it forever, up until about 10 years ago. Then there's the 506 deals, where you can take money from anybody and you can advertise, provided that those investors are verified to be accredited. So those are the two ways to raise money under Rule 506. What about incorporation in the U.S. Virgin Islands? Sorry to say, I don't know anything about that. I have not done. I don't think I've ever done a corporation in the Virgin Islands. I've certainly talked to people about Puerto Rico, though, incorporating there. And I understand that there are some tax benefits to doing that, but sorry, I cannot speak to that. Anonymous has another question. What are some of the benefits of the SBIC for minority-owned GP entities? How do they get structured into an existing fund? So SBIC, as we talked about, a small business investment company, the benefit is that they are licensed by the federal government, the SBA. You have to apply for a license. You got to go on and fill out an application. If you get the license, for every dollar you raise, you can borrow $2. You can leverage. You don't have to leverage it, by the way. And some SBIC funds won't because they don't want the interest charges. But you can leverage it. That's the real juice. So you get this access to all this new capital. But then you got to comply with their rules, and you can only invest in certain things. And you can also take bank investors, and because of the Bank Holding Act, that's something you can't do in venture funds anymore since Dodd-Frank, since 2008, I think. So anyway, the benefit is that you got access to a lot of cash. That's the benefit. The downside is now you're licensed and you got one more overlay of regulation. Who picks the investment committee? Is it a vote based on the LP's contributions? Depends on what your LP agreement says. Usually that's hardwired, that's predetermined. It's the LPs. Yes, it is the LPs. What it is, what vote they have, and how many people are on the investment committee, etc. That's all part of your limited partnership agreement. But typically, yeah, the LPs are going to pick and it's going to be the big. You're going to have an anchor tenant, a big LP, and you're going to have a few maybe. They're going to have a member of the investment committee. And it's not only valuation and investments that they're kind of weighing in on, it's also they're determining conflicts. So if the general partner has a conflict, they'll waive that, or they'll make that determination. We talk more about that these days because of, remember what I said, CFIUS, FIRMA. You really, as a practical matter, you're not going to be able to have a foreign investor on your investment committee because I suppose you could if you walled them off, but you can't let foreign investments have access to material non-public information or be in a controlling role be in a position to control the fund or its investments. So we have to be sensitive and be careful about that with foreigners. Let me put it that way. Someone wants to know the difference between an SPV and a SPAC, special purpose vehicle, and special purpose acquisition company. Well, they're as different as night and day. Since you asked, so remember the special purpose vehicle, I went through that really quickly, but what that is that's an entity, almost always a limited liability company. It's formed, it's a simple entity, pretty quickly usually, and it's designed for a special purpose. And that special purpose in this world is investing in one company. We're going to create it doesn't have to be. It could be formed to invest a lot of companies, but eventually it's no longer a special purpose vehicle. It's just a pooled investment vehicle. So usually when we say SPV, that's what we really mean. We mean you form this one entity, this LLC, to pool a bunch of investment. And instead of the company having 15 shareholders on its cap table, it's only going to have one, the SPV, which divvies up, its investment among its members. That's an SPV. Maybe it pays carry, maybe it doesn't. A SPAC is something completely different. That's a company that is formed to go public through a reverse merger with an existing operating company. Rob, we should do a whole session on SPACs. We could talk about that for hours, but we're not going to do that tonight because that is not really a venture. In fact, that's maybe a competitor with venture. Probably not. It's too late stage. That's maybe an exit for venture. How's that? Are there any VC funds that are benefit corporations? Well, now that's an interesting idea. No, there's not. And I'll tell you, well, maybe there are. I don't know of any. I haven't worked with them. I think the reason why they're not is because even a benefit corporation is subject to tax as a corporation under our federal tax law. And the tax law on corporations, as we said, is relatively punitive. You don't get that low capital gains rate, and you don't get that one level of tax. So I think the answer is going to have to probably be no. You know what? I should spotlight my screen. Sorry, I didn't do that. So the answer is probably going to be no for that. Now, there's another aspect to this question that is more interesting, and that's the idea of the social benefit or the impact. And in fact, I'm going to go back and change my slides to add impact funds, because that is a big deal now. Company funds are being formed for ESG, right? Environmental social governance. Funds that are being formed to do well while doing good, to actually invest in companies that make a big impact. Maybe it's on the environment, maybe it's social justice, maybe it's health and nutrition. I've seen that. Maybe it's climate change. I've seen that. Now, those are not benefit corporations because that would be a punitive rate of tax. The other reason why is because that's the beauty about limited liability companies. It's whatever your agreement says. So we had a time when benefit corporations came into the code. Right before that, Delaware and California. See, there's a benefit to being extremely old. I'm like a historian of some of this stuff, but all this trivia. If they would make a Trivial Pursuit game around useless laws, I think I'd be good at it. I'm terrible at trivia now. But there was a time we had something called an LLC3, which was a limited liability company. It was a limited liability partnership. And there was at the same time, we had a whole rash of new entities. And one was a limited liability company that was designed to be the analog to the corporate benefit corporation. In other words, it was designed for social impact, not just to maximize profits to its owners, but also to advance some social goal. We don't have those anymore. Statute was repealed, right? It only was around for a year or two. Why was it repealed? Totally unnecessary, totally redundant. You can do everything you want to do in an LLC. You just put it into your limited liability company agreement, right? So that's the beauty of LLCs. So the long answer to your short question is that no, to my knowledge, there are no benefit corporations because we just don't need it. We've got other ways of doing the same thing. Okay, regarding securities law, let's say we fund it with our personal money and we play an active role. We don't take outside investors. do you still comply with securities reporting and disclosure? Or let me back up. I might have gone over that too quickly. So what we have here is, so every sale of securities, it has to be either registered or exempt. You're not going to register, not the kinds of funds I do. There are exchange traded funds, but we're going to have an exempt offering, right? If you are exempt, you're not going to be reporting and disclosing to the SEC. What you're going to do is you're going to file maybe a Form D when you close your fund. But you're not going to do this ongoing quarterly and annual disclosures that public companies do. So that's not something you're just not going to have that requirement. You are going to have an annual ADV filing though, just keep that in mind. Now, if you don't take outside investors, then you haven't sold any securities, right? You and your business partner funded it with your personal money. Now, if you're active, now here's the definition of a security. Everybody I know is a securities law expert since blockchain, since tokens. And you might remember the definition of a security is that somebody is making money off of your efforts, off the efforts of somebody else. So if it's just you and your partner and you're both active in the fund, it's like a general partnership, it's not a security. Now, to be safe, I would still file the notices for the two of you, but there's nobody else. And I wouldn't even file a federal notice on that one, just whatever state you're in. So that's a long, complicated answer to say you don't really have a big problem. And more to the point, you got nobody to complain, right, if you don't have investors. But yeah, you need outside investors and the more outside investors, here's a corollary to that, is the more outside investors you have, the bigger the potential problem is. Because you call them investors, I call them potential plaintiffs. When something goes wrong, they're going to become looking at your documents really carefully. Which is the best type of entity if we're planning a global business model and looking for VC funds with minimum hassle? So I'm guessing that you're a portfolio company, a startup company, and not a fund. And you have a global business model and you're looking for VC funds. You should be a Delaware corporation. If you're looking for VC money from around here, I don't know about the minimum hassle. VC money comes with strings attached. It's expensive money. We do a whole program. We do two programs, part 1 and part 2, dealing with venture capital, that you should definitely watch the video or tune in to the next presentation, which I'm sure will be coming up soon. Okay, and we have a question, is the offshore blocker subject to withholding tax? So the answer is yes. Now, if that blocker, I called it offshore, I'm going to change my slides because it's really not. It's usually a US corporation. And the way it works is the fund is going to pay its share of the gains up to the blocker. And the blocker then, the US company, is going to turn around and pay a dividend back to the foreign holder. Now, depending what country the foreign holder, the blocker's in, there could be up to 30% withholding tax on that payment. And if they're in a treaty country, that withholding tax could be reduced to 0, for example. So you have to check what country. If they're in Cayman Islands, for example, yeah, that's 30%. But if you're in China, that's a treaty jurisdiction. It's a lower rate of tax. But yes, the answer is it's subject to withholding. Now, if instead, and this is why you use thank you for the question, because I should have talked about this. This is why you use a domestic blocker. If instead you've got a foreign corporation that owns an interest in the fund, I don't know that you've accomplished a whole lot, because the foreign corporation, now has got to provide the W-8 and now is going to get a K-1 and is now ostensibly in the US tax system. And if it's just a venture fund, there's no harm, no foul, because there's no tax on capital gains anyway, even for a foreigner. So I guess it would make sense in that scenario. But if that fund has any real estate gains or anything like that, yeah, then the foreign company ends up being taxed as though it were a US corporation, and then pays a secondary tax on any earnings that are repatriated as if it received a withholdable payment from a US corporation. I'm sure that's just way more than you wanted to know. Suffice it to say, this is withholding questions are hard. And I've been doing them for 30 years and they're hard. It's complicated. You have to think through a lot of different flows to get there. So we are at 8:29, 8:30. Oh, one more question. Somebody would like a link, a list of impact investment funds. I'll tell you what, Anonymous, if you will send to me an email or find me on LinkedIn or tweet to me on Twitter or maybe like me on Facebook or possibly heart my Instagram posts or otherwise find me on social media. As you can tell, I am not hiding. I promise you I will send to you whatever information I have. Or you can do it the old-fashioned way and just email me, since you have my email address. Okay, with that, we are at 8:30. This has been How to Form an Angel or Venture Fund, Legal Business and Tax Strategies. I'd like to thank you all for being good attendees, asking great questions, laughing at my jokes. And even though I can't hear you, I know that you were laughing hilariously. I got that, it came through. So thank you for that. That makes me feel good. And if you weren't, I'm still going to believe that you were. And make sure that you tune in for our next presentation, which will be in a couple weeks on another startup related topic. Again, we will be sending you an email with the slides, my book, as well as a link to the video. Thank you very much, and we will see you next time.